The global luxury markets boomed over the last 2 decades. Nobody seemed safe from the glitz and influence of runway trends. Well, most of them. Shoppers helped the sector almost triple in value during this time. But recently, things haven't been looking so rosy. Take this site in Beijing. It was supposed to be the city's hottest new destination for European high fashion. Instead, it's symbolic of an unfashionable new trend.
What we're experiencing is something that China has never experienced.
It's impossible to keep growing. According to the analysts who we interview, a lot of them believe that this is the end of the China luxury boom.
The Chinese market's been one of the growth engines of the world's luxury industry. Sales swelled into the tens of billions of dollars. Now look at this chart. This is North America and this is Western Europe, each smaller than Asia's slice of the 2023 global revenue pie. Like so many business trends though, the pandemic heavily influenced this, and here's why. In 2019, about 2/3 of all luxury goods bought by Chinese shoppers were picked up outside of China itself, through travel to hotspots like London and Paris. But when COVID-19 closed the borders, a lot of that shifted inside China. That's why this happened. Luxury spending in the country surged from 2020 through 2023. Exposing the luxury industry even more to the Chinese economy, which is now looking shaky. And that brings us to the present day.
We saw a slowdown and a contraction in the global luxury market. About 50 million people either opted out or were forced out of the luxury market over the past 2 years.
European luxury brands including LVMH, Kering, which owns Gucci, as well as Moncler and Burberry, shared hundreds of billions of dollars in market value in 2024. LVMH, the world's biggest luxury stock, and whose unfinished Beijing stores we saw earlier, recorded its worst annual performance since the global financial crisis. So, what went wrong?
The most direct reason is China's economic slowdown, which has been triggered by the property market slump.
Chinese consumers have been, looking at real estate as a vehicle for wealth creation.
And we have seen that a lot of middle classes' household wealth has been swept away by the property market crisis.
Then there's China's high youth unemployment rates. Aspirational young professionals have been key sources of growth for luxury brands, with more than half of China's wealthiest shoppers in recent years born after 1990. Their rising rate of unemployment, represented by this white line, is much higher than the national unemployment rate shown by the gold line, posing another major obstacle.
A lot of the aspirational luxury customers are now tightening their belt and are less willing to spend on big-ticket items.
So let's dig into this for a sec.
Hello, everyone.
Hello. 10 years ago, while working at JP Morgan, 35-year-old Zhuling Chen began building an influential following on Chinese social media, blogging about fashion and lifestyle.
I connected with a lot of the designer fashion brands. A lot of them are international brands. They wanted to enter China market because Chinese consumers just buy everything,
By 2019, Zhuling decided to leverage her social media popularity. She quit her job to start her own business.
Most of the time I spent, I was doing e-commerce operations and live stream sales activities. E-commerce sector was growing really fast in China. There's so many bloggers promoting products. So I do feel people started to get tired of purchasing products and realized that we just bought too much and it didn't really make us happier.
What she saw was a trend amongst young Chinese away from wanting to own things and towards experiencing things.
My readers, they wrote me messages saying that they pay more attention on mental health now, and they're trying to explore themselves versus just be an elite, have fancy jobs, and be a successful person. And then I shifted the business model into hosting wellness-related workshops, events, and retreats.
Many companies have benefited from young Chinese consumers choosing experience over extravagance.
They're more here for maybe taking photos and not necessarily translating completely into luxury purchase.
For instance, athleisure giants Lululemon and Arc'teryx, their annual sales on China's Tmall e-commerce platform have soared in 2024. And then there are so-called dupes, which are basically high-quality knockoffs, which thrive on e-commerce platforms.
A lot of consumers are moving into buying these dupe products because they think, okay, it looks the same, and they probably don't want the logos anyway because they want to be more low profile, and they can buy it at much cheaper prices. So, this trend is taking off in China massively.
Unless you see the price tag, playing spot the difference is hard. Original, dupe, original, dupe, original. You get the idea. But there's something else, though.
President Xi Jinping really has this idea about, common prosperity, which means he wants, people to be relatively equal in terms of wealth and, social status. And this has really deterred a lot of wealthy people in China to flaunt their wealth. And that's affected their appetite for luxury products.
So brands are shifting direction, targeting their most spendy customers.
A lot of luxury brands are now shifting their focus to focusing more on their VIP clients, who are the richest group of people who can still spend. For example, they are opening exhibitions, and they are hosting fashion shows, and they're even hosting concerts just to attract the younger Chinese consumers.
So the party might be over, at least for now, with China's era of extraordinary growth ending, and those unfinished flagship stores monuments to this new normal. Sales in the world's number 2 economy will most likely remain depressed in 2025. Companies like LVMH are turning their sights to places like India, the Middle East, and Southeast Asia in the hope they can make up for some of the shortfall.
We've got a new report actually out from Bain & Company saying China's luxury sales plunged by as much as 20% last year, bringing the market back to 2020 levels. The report says the fourth quarter showed only a slight improvement on the back of Beijing's stimulus promises. Wei Weixing is a partner at Bain and joins us now for more on this. So, is this sort of any surprise that we're seeing this slowdown? We had all the signals really all year coming through from different luxury names that things weren't looking too good in China.
Yes, exactly. So I think, before we talk about last year, we really got to put things into context, right? If you look at between 2018 and 2021, the market nearly tripled. That's astonishing growth. Of course, we know what happened in 2022. 2023 was a year of recovery, and then 2024 has really been the first year with real substantial decline. As you rightly pointed out, quarter over quarter, things sort of got a little bit progressively worse, with Q3 being really the worst of it. And then, of course, in Q4, with the stimulus announcements, we are starting to see signs of the market doing a little bit better.
Well, are there specific product categories that did certainly worse than others?
Yeah, I mean, first, all the categories were affected, but some fared better than others. So on the more positive side, beauty had a single-digit decline and did relatively well. And that's because, you know, in sort of tough economic times, consumers are looking for these small luxury purchases, and they're looking for sensorial experiences. So as a result, you know, fragrances and color and ultra-premium skincare has also done very well. But on the other spectrum, jewelry and watches have really taken the biggest hit. In a way, they are the ones that historically, compared to the other categories, have performed a little bit worse as well.
What else sort of stood out was also that a lot of the spending that is happening, because Asia Pacific didn't do too badly, and it's really one place, and that's Japan, and it's the weak yen. Do we need to sort of think about it? You know, it doesn't really matter. It's agnostic to country. It's more about Chinese consumers, and they are still spending, but just maybe not in their home stores.
You're exactly right. Actually, when we think about sort of mainland China luxury consumption, we got to put it into the context of the Chinese cohort. During the COVID years, the border was closed, right? So the vast majority of luxury consumption happened within China. Actually, at the peak of it, 95% happened within China. Versus last year in 2024, we estimate about 40% actually happened abroad. So that is actually one of the key reasons why we're seeing the market take a hit as well. And as you rightly pointed out, the travel to Asia Pacific and luxury consumption to Asia Pacific has recovered to 120% of the 2019 level. So indeed, people are going to places like Japan, Southeast Asia to make their luxury purchases.
This might be anecdotal, but I'm wondering, are price levels in Japan, because of the exchange rate, actually cheaper? In other words, what is that arbitrage trade, if that makes sense?
It's very sizable. Okay. And for the consumers that are price sensitive, it is very attractive. We did a snippet, a spot check of different, I guess, popular products.
Yep.
And we saw price gaps as large as 30%.
Wow, okay.
In different categories.
So how does that play then into grey market activity as well?
Yes. So gray market has always been there. They get a little bit bigger or smaller depending on the time. Of course, the price gap between Japan and China and other markets, they are contributing to the gray markets, but that tends to be individual or small-scale daigous, as we call it.
Yep.
The real big sort of business-like scale daigous, we believe the sources of the products are actually coming from the wholesale channels in other places and not necessarily due to the currency fluctuations.
What about other places where traditionally you did see a lot of the luxury purchases, for example, Hong Kong? And if you could also compare, Europe is also a good example.
Yes, of course. So in Europe, we're seeing the level to have recovered to about 65%. That's compared to last year,
that's
about
not a lot,
40%.
Okay.
Yes, I mean, there are still, overall, people are definitely showing more of a preference to travel to Asia Pacific, somewhere nearby, as opposed to Europe. So that is affecting it. Hong Kong has been mixed, right? Hong Kong has been soft. The good news is we're seeing the tourists coming back. You very much see them on the street. But perhaps the profile of the tourists and their purchasing behaviors have evolved a bit since before 2019. They're more here for the experience, for maybe taking photos, and not necessarily translating completely into luxury purchases.
Yeah, I was actually going to ask you, how much of this is obviously economic in nature, and how much of that is just a shift in consumer behaviors, and how much of it is also generational too?
Yeah. I guess, some of it is the mix, the profile of tourists that are coming here are a little bit different. We're getting sort of the GBA ones that are coming in groups, and we're, of course, getting a lot of young people that are coming here, like I said, more for the experience, right, for the photos and so on and so forth. Yeah. So as a result, it really hasn't completely translated into purchases.
Okay.
We do have a segment of Chinese, I guess, affluent immigrants that are now living in Hong Kong. But what we see is many of those relationships with their sales associates are still in mainland China. So it will take some time before the effect of that is seen.
So what's your outlook then for this year? Do you see any sort of improvement? And which brands are standing out to you? I mean, a lot of people will say amidst, for instance, is better at withstanding it than a lot of others. But anything there's to note?
Yeah, many of the brands did not do so well this last year, but you're absolutely right. There has been bright spots, right? And it's not necessarily the biggest brand. Scale is not really the only indicator, if you will. There were a few smaller brands because they truly have been able to create that connection with the consumer and have a very distinct value proposition. They've fared well as well. So, outlook for this year, I guess we're cautiously optimistic. We think 2025 will probably end flattish. First half will still be challenging. January was not great. But as the more stimulus come into play and to stimulate overall consumption, luxury will be no exception. So we believe second half will be a little bit better. So ending the year on a flattish note.
Yeah, a lot of the issues, to your point, right, are outside the control, really, of both consumers and sort of the companies themselves. Within the control of companies, what advice would you give right now to luxury names, for example? How do they engage with their clientele?
Absolutely. It's a time to go back to the fundamentals, right? If you think about what has driven growth in the last few years, it was really rapid store footprint expansion, price increases. Those things won't necessarily hold in this new era. Now it's going to be much more about coming back to the roots of the brand, right? What do you really stand for? Are you distinct? Do you have a clear point of view? And are you able to really offer the products and the assortment that fit the lifestyle and the desire of this new generation of consumers? So that will be the key. And we certainly believe there's still huge opportunities to be unlocked, and the brands that are able to do that will perform well.
China's growth looks set to decelerate in the second half of the year after a resilient first half. As export front-loading fades and retail sales remain stuck at mid-single digits, showing little sign of immediate recovery in non-subsidized sectors. But in this downturn, gold has surged, and along with it, pure gold jewelers like Laopu.
Bennett & Co estimates that China's luxury market sales last year had plunged by 20%. But Laopu Gold bucks the trend because gold jewelry is not just a symbol of prestige, it's also a hedge amid falling property prices and volatile financial markets.
Walk into a luxury mall in China and you might find a long queue of people waiting to enter its stores. Since its IPO in June last year, the share prices have soared 1,800%.
I am born and raised in China, right? When I think of a piece of gold jewelry, usually I associate that with something my parents or even grandparents' generation would wear.
Gold jewelry, once seen as old-fashioned by some, is making a comeback driven by Laopu, which has flipped the script by embracing heritage gold, hand-engraved heirlooms using ancient goldsmithing techniques once worn by emperors and nobility.
The overall trend of embracing this cultural heritage or, Chinese aesthetics inspired products, I don't think all of that is just a fad. It's definitely a sustainable trend.
This has helped the firm attract a younger audience. Moonfox data says more than a third of its buyers are aged 26 to 35. Laopu has become one of the three sisters of new consumption, alongside breakout stars Port Mart and Mixue. With the government boosting domestic demand through subsidies, analysts say non-subsidized sectors can still find growth with premium offerings, localized branding, and improved customer experiences, exactly the strategy that Laopu is following.
They try to plant or combine or embed their own kind of cultural component into their design, and that is why we actually think Laopu has actually the highest potential to be the first legit Chinese high-end luxury brand.
Despite the share prices rallying triple digits this year, investors are still bullish, with a 12-month price target 30% above the current trading price. The true test, though, is whether Laopu can still shine when the gold rally fades.
Laopu is also trying to decouple the relationship between gold price and its own product price. So I think ultimately what it wants to achieve is that consumer is not paying for Laopu because they want to buy the pure gold. People want to pay for Laopu's price premium because they want to pay the brand premium.
For now, analysts say demand for gold is giving Chinese jewelers such as Laopu and Chow Tai Fook a leg up over foreign rivals including Cartier and Tiffany. And brands tapping into the demand for culturally rich premium products could be the gainers in China's consumption space. Min Lo, Bloomberg News, Hong Kong.
Obviously, we talk about this phenomenon where, the Chinese are not quite spending that big domestically, but really they're heading abroad. What's the outlook of that? Is that a new trend, a new normal that we're seeing now?
Yes. So first of all, let me start with a headline message, which is Chinese have not lost their desire for luxury. That is very clear. I think there are two ways to tell the China luxury story. You can look at the mainland China spending, and you see a substantial decline for most luxury brands. Some of them actually declining double digits. At the same time, there's also the other side of the story, which is the overseas spending that you were alluding to. And in fact, it has in the first half of the year been above what we had pre-COVID. So the first half of 2024 has seen more Chinese overseas spending than it has in the first half of 2019. And that is quite remarkable and different than most expected. Japan is one, but also the recovery in Europe has actually been quite strong. So in that respect, I still would conclude we still see Chinese having a desire for luxury and still spending. Less than the past. I think that is normal in the overall economic context. But it's not the end of China luxury.
Not the end of China luxury, but Jacques, perhaps we can bring you in here. What are you seeing about these new trends emerging? Because there's also a lot of grey market activity that we see. New buying channels are emerging in the mainland as well.
So I think Danielle is absolutely right. The appetite is definitely still there. The first thing that needs to be well understood is that the current economic environment is not impacting all brands the same ways. The brands that have been focused on the Chinese middle class, that have been focused on new customer acquisitions for the last 10, 15 years, are far more impacted by the current economic environment in China than the ones that have been focused on delivering the pinnacle of luxury. And I think the results in the last few days of Hermès are a best example of how different brands have been able to protect themselves from the current environment. The second point is we're talking about the Chinese luxury market. And the Chinese luxury market is far more than the performance of luxury brands in China. Meaning, aside from the gray market that you were just mentioning, there's all this consumption that's taking place outside of China. And we're not talking about just any consumer. We're talking about the Chinese luxury consumers who pre-COVID were spending 2/3 of their luxury expenditures outside China. Now, obviously, during COVID, the only thing you needed to look at in order to understand the luxury market was the spending of luxury consumers in China. But today, that's no longer the case. And these people are slowly reverting to that behavior now that travel is resuming, to Daniel's point.
So Jacques, how do you see this all looking like? If this is a trend that's here to stay, is there a particular number that you could put behind it? I mean, what percentage do you think we're going to see Chinese spending domestically, and how much percentage are we going to actually see heading overseas to buy?
We fully expect that over the next few years, Chinese consumers are going to go back to spending 2/3 of their luxury expenditures outside China, which is why we project the revenue of luxury brands to only grow at a low single-digit CAGR over the next 5 years in China, while consumers starts taking advantage again of the opportunity that they have to purchase goods outside China, which is, in line with what they've done in the past. And that's why a lot of the narrative around a challenge luxury market in China is to a large extent misleading, because the revenue of luxury brands today should not be compared to the revenue of luxury brands in China last year, but to 2019 when the market conditions were identical from a traveling opportunity standpoint.
Daniel, how do brands go about meeting customers? Because we just showed a graphic there looking at the most successful brands in this market, Hermes, Chanel. They're ones that have been very successful at building long-term one-on-one relationships with the wealthiest consumers. If Chinese consumers are going to be buying outside of China, how do they meet them in the mainland to make sure that they're ready to meet them overseas?
Yes. So first of all, I think you're alluding to the key point, which is the purchases done overseas are targeted purchases. People do not travel and explore. While they're in the mainland of China, the brand perception is built, the desire is built, and when they travel, they will go and buy exactly like the brand they desire, and they take that decision ahead of their travel. So to your question, how are the brands responding to that? It's very interesting to see. There is a bit of a shift away from major capex investments. So we've seen less store expansion in the first half of 2024 compared to what we've seen last year. At the same time, we see an increase of brand events, PR events, where brand is being built, relationships with the high net worth spenders are being built, and the brands basically take a global view. And they say, well, we're investing in China, we're putting our marketing dollar behind, we're engaging with our consumers in China. However, it ends up in a different P&L, be it in Japan, be it in Italy or elsewhere.
You mentioned, I mean, a lot of these brands, they invested heavily in China during COVID.
Yes.
And now you're seeing that investment being pulled back a little bit, maybe to go to overseas markets. But what can they do domestically? Is it price cuts? Is that the answer that they can do?
Well, I think the price harmonization, has been going on for a number of years. Speaking of which, I think there's now a bit of an imbalance with Japan, given the weakness of the Japanese currency. But in large, I think luxury brands know how to bring the prices closer together. I think the key, but the overseas spending will not go away. It's part of the experience. It's an occasion. I travel somewhere, and yes, I make a bit of a bargain with a bit percentages, maybe less, but that's not the part. It's also the memory of returning from Italy. It's a memory returning of France. So I think what the companies have to basically get used to is that their marketing spending in China will be disproportionately higher, while an increasing part of the revenues will be from overseas.
Suffice to say, you're satisfied with results?
Yeah, we've been focused on this 3-year plan strategy we have been embarked on. Growing our luxury, growing our high-end fashion business, growing also sports business, but at the same time, diversifying our production base across Asia. And this is the first year of our 3-year plan. And we're ahead of the schedule with a 10% operating margin target and a low teens profit growth. But we actually beat both of them in the first year. And looking at the next 2 years, our momentum is actually very strong. I would say we have more demand than we actually have capacity for at this point.
And your ASP has been rising,
yes.
Particularly because you are shifting more towards the high-end luxury premium products as well. Is this a lasting trend that you're seeing?
The thing is, this is absolutely true. As we move into more luxury, more high-end fashion, like say someone like a Balenciaga or Balmain or Amiri, which is a really hot brand right now, the ASP in the product is higher because the quality and complexity is so much harder. And that's actually, they come to us because they think of us as the best footwear maker in Asia on product development and quality. We're not going to be making a large volume. We're a small batch manufacturing, but more atelier style. And that's why they come to us for that product. And their product just fundamentally has higher ASP because it's more premium.
Yeah.
Why was revenue down? I noticed that it was left out of the... I understand why it was left out in the highlights, but then I turned 2 pages and then I saw the revenue was down. Just underscore the drop in revenue.
David. It's true. So the funny thing is that once we move to luxury, the time it takes to make a luxury product is 4 to 5 times the amount we make a regular product. Okay? So like the output actually goes down. So the volume goes down, but then also the revenue goes down as well because it doesn't make up for the ASP is not 4 or 5 times higher. Okay. So in aggregate it goes down. But also there's a second element. Last year we do have a sports customer where there's more inventory issues in the channel. Okay. But all of that is gone now. So everything's I would say inventory in the channel for our customers is pretty healthy at this point.
And what markets are doing well?
We ship to our customer, the global brands. They ship to Europe, US, and China, all over Asia. So they've been really moving around. And obviously, a funny thing is 2023, China was actually up for us. Okay. And the funny thing about that is that a lot of our brands actually never really had direct-to-consumer stores in China. Okay. They were selling mainly directly online, and then when COVID happened, Chinese shoppers stopped traveling. They had to find a different path, basically opening stores, tailoring a marketing strategy, tailoring a new product. That's China for China. And that's actually somewhat, I would say, luxury and high-end fashion brands are addressing now, and why China actually grew last year for us.
And the outlook for China-specific this year?
You know, it's I can't comment on the macro side, but, you know, I think things seem weak. For our business, because we have over 40 customers, and they all have different strategy in terms of China, but what we hear from them is that they're all really looking at investing in China, because they think it's still the largest consumer market, you know, well, not largest, but second largest, but then you'll be probably one of the biggest potentially. And, you know, there's, especially on the high-end side, there's still a lot of aspirational shoppers. They will kind of get to that part where they will spend more money on the luxury and high-end fashion side. So what they want to really do now is just really focusing on the right marketing strategy and store and product, working with us for the China market.
You also have been talking about your 3-year plan about where you're really putting your manufacturing facilities. A lot of it which has been in Vietnam, but you're kind of diversifying out to more of the Indonesias, the Bangladeshis out there. Just walk us through what that strategy is now.
You know, in terms of production, it's all about diversification. I think we all understand that in Asia, there's a lot of geopolitical risk, locally in the economy or across countries. So one of the things we always try to do is be preventative. And we open factories in Vietnam, Indonesia, Bangladesh, and Philippines. And also, of course, we started in China. We have so we can provide our customer that diversified base. So they can come to us and say, they don't have to go to anyone else. Just come to us. We make good product for you, good quality, and we also don't have to worry about disruption.
Okay. If I could, since you're the CFO, let's talk about finances. Sure. Your stock's up. Do you think your stock is undervalued? Like, what's the general sense of how the share price is?
Yeah.
And I guess the other question there, since we're talking about it, I'll ask it anyway. Are you planning on giving back money to shareholders in the form of buying back your stock?
Okay. So we currently trade around a 9% dividend yield. So we've always committed to a 70% payout ratio for our profit. So we are definitely returning cash to shareholder. And that's a focus for us. Now, in the discussion on share buyback, you know, we have discussion with our board. I think for us, you know, there's different perspective from different shareholders. Some are more tax efficient, obviously, for buyback. It's different that feedback we won't get from all of our shareholders. So it's not just one, but all of it. And then we'll probably decide later on what we want to do.
Okay.
You also have plans to scale down your operations in China as part of a strategic plan and creating more value for shareholders.
Yeah. So I think there's two things in China. One, we have a manufacturing, which is a larger operation versus the retail side. The operation in China is more about, we're not scaling down. We're looking at that facility for China. Okay. We're actually doing more product development for those facilities for product tailored to the Chinese market. Now, the second thing is about our retail business. We have been shutting down our retail business globally because we have so much, I would say, demand on the manufacturing side for footwear. And we're looking at, anything else, the next 3-year plan is really growing our handbag and accessory side. Okay? So there's so much focus on that. There's just not enough management time for all of us to deal with the retail brand as well.
Yeah, all of you guys need some sleep at some point, right? The executive team as well. So is that a trend that continues? Are you do you see eventually the company moving permanently away from retail? Is my question there.
I think there's no plan. I mean, I would look forward, for both Stephen Chi, my CEO, and I, we're looking at the long-term plan beyond this 3-year plan. Next 3 years, the incremental focus is probably handbag and accessory. Now, beyond that, we haven't had that discussion yet, but probably not in the retail.
Okay.
There's a lot of consumers and the like that are really gravitating towards sustainability, eco-friendly sort of products. I mean, is that something that you're very much attuned to here right now in terms of...
Oh, absolutely. So we have some customers that we have recycled material soles. Okay. So, but that's kind of the DNA of their brands as well. So not all brands have that DNA per se. I'm all recycled material, but some brands are like that. But in general, across all of our, luxury and high-end fashion, their quality for ESG is very, very high. So to be able to do business with them, you have to have a very, very high standard. And that's what we live by. And then we actually have a dedicated ESG team just to focus on this area to make sure that, we follow all the ESG practices, but also how we get better in this aspect.
Right. Any priorities along that front? That's an evolving story, right?
Yeah.
And you have to follow what your customers do.
Yeah.
Almost on a weekly basis. Just give us a sense of how that story is in your head moving forward.
Yeah, I think one of the things is for ESG is like renewables. We want to make sure we have renewable energy. So we actually install solar panels across all our facilities. Okay, and there are factories that I would say countries where we operate in that solar panels not so I would say common. I would say this is something that we're actually leading the effort to do that.
I guess I have to talk about the macro picture, which is inflation, which still remains elevated in some parts of the world. I'm just wondering, do you still have sort of the pricing power to kind of pass on those costs to your consumers?
And
are
you feeling inflation cost pressures too coming up?
Yeah, for us, when we work with our customer, they come to us for high-end product development and quality. Okay, their demand and also their end consumer demand is high-end quality. So it's not like they're not price sensitive, but they focus more on quality versus pricing pressure. Now, when we look at costing with them, we're completely transparent. How much we pay our workers, and they want to know as well. We want to make sure we treat our workers at a factory level at a very high standard so that they are very comfortable with. And also the cost of material. A lot of times the leather, the special material that these luxury brands have is their material. Okay? So in a way, it's kind of almost a pass-through for them.
You talked about brands like Amiri, which is something that, one of your partners in all this. I mean, there's this new rise of luxury brands right now.
Yep.
How do you see this whole competition with some of those traditional luxury? How is that going to play out?
Amiri is a growing brand from LA. They just dressed Travis Kelce for the Super Bowl.
Did they?
Topical.
Yeah. Okay. Very cool.
Very timely.
I cannot pull that suit off, but he can. He's also dating Taylor Swift. I'm not, so very different. Now with Amiri, that's one growing customer, but we have won over 16 customers over the last 3 years, and that's a focus. Because with brands, you have some taking share with another. You never know which one goes up and down. So it's very important from a business model perspective, have a diversified portfolio of customers. And that's what really kind of mitigates a lot of your business risk.
Final question. So you mentioned, you had a drop in revenue. You mentioned that was because of this pivot towards luxury. Is that a permanent thing? Is this pivot to luxury going to cause your revenue to trend lower, or is that a temporary thing? What's your revenue target for the year?
So when we look at it, it's almost apples and orange comparing as we make a transition. Okay, from what we're currently now versus like what we did 4 years ago. We're at this point, we're at an inflection point where we kind of the mix we have of luxury and fashion is pretty more stable, close to what we target. So I think going forward, next couple of years, we'll probably see revenue grow. And also profit are growing along with it as well. But more importantly, our target is net profit after tax. Low teens CAGR for the remaining of 3-year plan. We're ahead of the ball game, and we feel like the momentum is pretty strong for our business to continue that.
Okay. Andy, thank you so much.
Thank you so much.
We didn't get to zoom in on your shoes, and I didn't get to ask you what you're wearing.
Wearing Amiri today.
There we go.
There you go, Travis Kelce.
Okay. There we go. A little bit on your screens. Here's mine. Come on. A little bit. Go. There. Okay.
I wish I could wear sneakers.
Yeah.
Andy Tam, CFO, Stella International Holdings.